Good morning. My name is Tim Gregory. I'm the Chief Investment Officer of Vermeer Investment Management based in London. And I'm here to talk to you this morning just about what we see today and ahead and what is a very important day for the market actually, with the Federal Reserve decision on interest rates expected this evening, the Chinese and American delegations on trade getting together today and actually ending their talks, and in the light of earnings from Apple, the biggest company in the S&P 500 by benchmark weighting, along with Microsoft, which has already reported very good results. And Apple had very strong results last night, so shares were up in aftermarket trading last night, and obviously we will have to see how they trade this afternoon. But the company continues to perform strongly, particularly on its services division. AirPods are a growing part of the profitability of the group, and they seem to be offsetting the weak performance that I think was well known to the market from the iPhone business before we move towards 5G, which is going to be a very new, exciting technology for the mobile phone industry and for many of the companies who serve it, and is a very interesting investment theme going forward for investors to look at as we move into 2020 and 5G proliferates more and more in the mobile phone industry. But onto the Fed, where a 25 basis point rate cut I think is expected now this evening. The Fed is in a challenging position. Yesterday's consumer spending and housing market data was very robust, questioning how far the Fed should go in terms of rate cuts at this point in time. But against that, the industrial economy has really slowed, and this of course has been impacted by the trade problems, which over the last 9 months have seriously shown an ability to weaken confidence in spending and put the capital investment cycle under significant pressure. So we await any comments officially on how trade negotiations went today, but they remain very important for there to be a recovery in the industrial cycle. So the Fed is faced with the prospect of trying to decide a course for interest rates which is based on a consumer economy which is doing perfectly well. GDP growth in the US was strong in the first half of this year, much better than elsewhere in the world, in the developed world certainly, particularly set against the backdrop of how Europe is performing at the moment. And there is of course the Brexit uncertainty, which is also casting a cloud over investment spend in that part of the world. So industrial economy weak, consumer economy strong. What's the Fed to do? I think it will take the middle course. It will cut by 25 basis points, and it will probably then decide to be data dependent going forward. If we had the coupling effect of lower interest rates helping the consumer economy to continue to go well, we've already seen that the bond yields around the world have gone largely negative. 13 trillion of assets now have negative yields. 10-year US government bonds are yielding 2. 30-year yields are very low levels, and that's encouraging the mortgage market, and that's helping the housing market. So the consumer economy is doing well, and so I think I think the Fed will do 25 basis points and then wait and see, because if there is a resolution to the trade-related issues and the pent-up capital spending cycle that has been impeded over the last 9 months were to pick up, you could see a very strong response from the US economy in the second half of the year as all those factors come together, which would be very beneficial to the president going into an election year if the economy was running very hot, showing his policies to have been working. So obviously we'll have to wait and see on those things. In the meantime, we have had, generally speaking, a very strong earnings season. I mentioned that Apple had good numbers last night. Mega companies like Microsoft had really strong numbers, and they've well past the trillion market cap mark now, having pressed on towards new highs. And in general, across many industries, we've seen some very strong results as yet again US corporates show their resilience and the strength of their cash flows and their ability to deliver earnings quarter on quarter. And that is helping a market which is focusing on the opportunity in equities, because bond yields are so low, and so equities look favourably when considered to that, particularly those that have strong and growing yields and are showing good capital discipline and capital allocation. Thanks very much for your time today.